Hello, everyone, and welcome to today's presentation on UK tax planning. My name is Vincent Wilson. I am the partner of Holborn Assets, Saudi Arabia, and I'm very pleased to be joined today by Neil Chadwick, who is Head of Technical Services for RL360, who are one of our major preferred international partners in the financial planning arena. I'll just, by way of an introduction today, just give a quick recap on my company, Holborn, and Neil's company. And then I'll hand over to Neil to give us the latest information on UK tax planning options. But just as a quick sort of analogy, as a financial planner myself, we often like to use the analogy that we are kind of like going to see your GP, whereby we look at your holistic financial situation and we can sort of make some diagnoses there and make some recommendations. But sometimes when you see your GP, he might say that you do need some specialist to have a consultation with, whether that's a cardiologist or an endocrinologist, whatever it may be. And in tax planning and trusts, that's a kind of the similar situation where it can get a little bit specialized and a little bit technical for a few reasons. A, it is a little bit more of a complicated area just by definition, and B, new governments come in all the time, as they did recently in the UK, and they like to have a little tinker around with some of these rules and regulations. So it does require, some very sort of specific implementation and information to make sure that you are doing the planning correctly, make sure you don't fall foul of any of the changes in legislation. So that's just a basic idea there. So I'll just run through a quick introduction on Holborn and Neil's company before handing over to him. So Holborn Assets, you may already know, but if you don't, we've been around for a long time. We have been in the industry now for over 25 years. We've got over 20,000 clients all over the world. We have many different offices, and we manage about $2 billion for those clients. These are the main offices main locations where we have offices. As I said, I'm the partner of the Saudi Arabia office, so I run that location. But we are in many different jurisdictions, and we are regulated everywhere that we have an office, of course. We have quite a nice score on Trustpilot, so feel free to go and check us out on there. It's nice to say that our clients generally say pretty good things about us, so that's good to see. Feel free to go and have a browse on there should you wish to do so. And we are very often in the financial press talking about the different areas of the business that we are working in. So feel free to check out some of those links if you'd like to just see the different areas that we've been active in recently. We always enter the International Investment Awards every year, and happy to say that we generally usually pick up 2 or 3 awards in there relating to different parts of the business, often customer service, that type of thing. So that's quite nice to say as well. Neil works, as I said, for RL360, but the parent company of RL360 is IFGL Group, who are an absolute behemoth in the industry. They run $23 billion of assets for over 200,000 clients all over the world. So very, very big presence. And we're very happy to be working with IFGL in different ways. And these are the different brand companies that IFGL have. And RL360, there being the one that Neil works for directly. And Friends Provident International, I think a very famous brand in the UK and the international insurance arena. And they are all based in the Isle of Man, so are regulated by the Isle of Man Financial Services Authority. So that's a quick brief background and intro. And with that, I'll hand over to Neil, and he can give us the latest details on the planning options available for UK expats. So I'll stop sharing my screen there and hand over to you, Neil.
Okay, thanks, Vincent. Thanks for Vincent for giving us the opportunity to talk to you all today. Inheritance tax, like many other taxes around the world, and certainly from a UK perspective, is something which is kind of changing all of the time. And since the introduction of a new administration in the UK last year, that's definitely been the case, really. So there's now a new residence-based regime in the UK. Excuse me. This has replaced the domicile provisions that have been around for as long as I can remember, which were incredibly confusing for lots of people. So what they've done is try to simplify things now by moving to a residence-based regime, whereby it's a lot easier for people to understand whether they are in or outside of the scope of the UK inheritance tax system. So if you are a long-term resident of the UK, which means that you've been UK resident for more than 10 out of the last 20 years, you're in scope. And if you have been outside of the UK for more than 10 years, then you are classified as a non-long-term resident and you are out of scope. Now, with all things, certainly in relation to the tax system, there are winners and losers with all of this. In particular, for people that are leaving the UK, you do have to be a bit careful of a tax tail, which now attaches to you, whereby depending on how long you've been a UK tax resident, if it's been 10 years or more, then you will remain inside of the UK tax system for a period of time after you have left. Also, for anybody that is in what you would currently define as a mixed domicile relationship, where you've got UK dom married to non-UK dom, the non-UK dom can elect to become UK domiciled in order to receive their spouse's full assets free of UK inheritance tax. Going forward, they'll be able to elect to be deemed to be a long-term resident, which would have the same benefits. But previously, currently where they make that election, that remains with them for 4 tax years. Going forward, that election to become long-term resident of the UK will remain with them for 10 years. So significantly different there in terms of tax policy.
Could I just jump in and ask there, Neil, then does the concept of domicile no longer become relevant at all then for UK inheritance tax?
No, it's now going to be a purely residence-based system. So a lot easier for people to follow. So individuals would need to look at the statutory residency test for the UK, which was introduced in 2013, which sets out the number of days that you can spend in the UK each year without being deemed to be tax resident. And it will be those tax years going forward that will be relevant in terms of whether or not someone will have an exposure to UK inheritance tax.
Okay, thanks.
Another change in policy is that from 2027, UK pensions, so for example, UK SIPs, self-invested personal pensions, will be within the scope of UK inheritance tax. So any pension benefits that an individual would have, which exceed their available nil rate band. The nil rate band is the inheritance tax free amount, which is currently £325,000. So if you look at someone's total UK estate, let's assume that the only UK asset they've got is UK pension. If on death it's worth more than £325,000 and those pension benefits are not being left to a spouse, civil partner, etc., then they will be subject to UK inheritance tax at 40% over and above the available nil rate band. For someone that's going to be classified as a long-term resident of the UK, that will be their worldwide pensions, so QNUPs, for etc., things like that, as well as UK SIPs. And for non-long-term residents, so those people that aren't resident in the UK and have been outside for 10 years or more, that would only be on UK resident pensions, so self-invested personal pensions. So there are planning opportunities. We are seeing lots of people look at how their country of residence, and in particular the double taxation treaty that is in place within their country of residence in the UK, would potentially allow those pension benefits to transfer out free of UK tax or at a potentially reduced rate. So when we look at IHT mitigation, and we're not going to focus anymore on pensions for the remainder of this talk. There are generally, one or two options. First of all, give it all away. or spend it all. Neither of those two are, particularly conducive to a good lifestyle going forward, unless you are absolutely filthy rich and you can afford to give all of your assets away and not really have too many concerns around where they end up. For those that do have concerns, then typically you've got thoughts around, well, I'm losing access to all of this now. What happens if I need it back? Or if you are giving it away to somebody else, you're going to be losing control. What happens if they don't do the right thing with it? Are they going to inherit those assets too soon? Are they going to spend it? Are they financially savvy enough to be able to, monitor those funds and do things in the right way going forward? So where we get into conversations around IHT mitigation, really you are talking about using trust structures to be able to gift assets away in a precise way, potentially have access to some capital, some income, and more importantly, control who gets what and when they get it, and have a mechanism in place that's going to be able to facilitate whatever your succession planning requirements are. So, for example, when children will inherit, grandchildren, aunties, uncles, brothers or sisters, whatever. But you've got a precise structure there that will be able to facilitate a vast range of different planning opportunities. Now, the particular opportunity that we're going to talk about going forward is something called a discounted gift trust. And that's a particular arrangement which allows individuals the ability to have access to their income and potentially some capital, whilst at the same time making a tax efficient gift for inheritance tax valuation purposes. So how does this work? These particular trust structures are linked to insurance wrappers, so offshore bonds, etc., whatever name you're more familiar with calling them, whereby the individual would take out the offshore bond. That offshore bond would then be transferred into a particular trust structure called a discounted gift trust. Under that structure, the individual would carve out the rights to receive a regular income stream for the remainder of their lifetime, or until such time as the trust fund has been exhausted. Now, there are two elements to this particular piece of planning in respect of how it works. The first part is the retained rights, which is the income stream that they carve out. And under HMRC rules, the value of those retained rights would fall outside of the individual's estate on day one, with the remainder, which is the discounted gift, falling outside of their estate over the next 7 years. So even if someone gets hit by a bus day two after setting up this particular piece of planning, the value of the retained rights falls outside of their estate for inheritance tax valuation purposes. So it's a fantastic benefit. Also, from commencement, any growth which accrues onto the value of the trust fund will fall outside of the estate immediately for inheritance tax valuation purposes. So how does it work, and how are the retained rights calculated? Well, what happens is that the settlor, so the settlor is the person that creates the trust fund, sets out the level of income that they're going to require going forward. An actuarial calculation is then performed to work out the value of that income stream going forward in accordance with HMRC's rules, guidance and principles. That's a very, very important point, that you can't do anything weird and wonderful here. There are set parameters that you need to follow in order for the value of the discount to be credible if there was ever an investigation by HMRC. So once that's been worked through, then that's the amount that you've given away. Therefore, that's the amount that falls outside of your estate for inheritance tax valuation purposes immediately after undertaking this particular type of planning. So why is there a discount? How, normally if you give away £1,000, the valuation is £1,000, and you need to survive a set number of years, 7 years, in order for that to fall outside of your estate for inheritance tax valuation purposes. Well, the way that the rules work under the HMRC rules and practices is that if someone sets out that they're going to retain the rights to receive an income stream for the remainder of their lifetime, then under the actuarial calculation that's performed, technically they've never given that money away because they're going to receive it back and they're going to spend it. Therefore, under the HMRC rules, you're given a discount, and therefore that value of that income is discounted from the overall transfer that you make into the trust fund.
Sorry, Neil, can I just ask there? So you can, just to confirm, you can receive an income from the trust, and that the amount of that, the value is not taken into account for inheritance tax if when there is an inheritance tax calculation later on. Is that what you're saying?
That's correct. So the actuarial valuation of the income stream falls outside of the person's estate immediately once the trust is set up.
That's the entire income stream?
Yeah, so the entire income stream. So to give you an example, and we've got some examples further on, but let's say you've got someone that's got £1 million that's transferred into a discounted gift trust. They're going to take a certain amount of income a year, let's say, and we value that at £600,000, that they're going to receive their value of that income during the remainder of their lifetime. That £600,000 would fall outside of their estate on day one. So over the course of the next 7 years, the value that remains in their estate is £400,000. So once they get to the end of the year 7, the full $1 million is outside of their estate for inheritance tax valuation purposes, but the entire value of the income stream falls outside of their estate on day one.
Right, but that 600,000 income that they're due to receive assumes that they die on a certain date according to average life expectancy. Is that correct?
That's correct. So we'll use standard mortality tables, which are prescribed by HMRC. So let's say someone that's 60 might have a 25-year life expectancy. So that's the life expectancy that we'll use to establish what the value of that income stream would be. And therefore, they're expected to live to age 85, but if they don't, it doesn't matter in terms of how the calculation's performed.
Okay, excellent. Thanks.
So to look at an example here, we've got Jane. She's 62 years old. She's in good health, and she has a requirement to receive 5% of the value of the trust fund going forward annually. So let's look at the value of her estate at the moment. So she's got bank deposits, she's got investments, and she's got a UK pension, which is going to fall into the scope of IHT from 2027. So her net worth at the moment for IHT purposes is £950,000, and she's also got an annual income which will be £22,500. If she were to die, and we'll say post 2027, bringing in pensions into the scope of the calculation, then after we take off the available nil rate band of £325,000, that would leave her with an inheritance tax liability of £250,000, or more importantly, her estate would have an inheritance tax liability of £250,000 that would need to be covered. Now, if we restructure the bank deposits, and that's moved into the insurance wrapper, offshore bond, and then into the trust structure, then by taking 5% a year of the value of the trust fund going forward, that £450,000 can be discounted down significantly, so that over £320,000 would fall outside of Jane's estate on day one, with the remaining £129,150 falling outside of her estate over the course of the next 7 years. So quite significant. So that after 7 years, the full value of the estate, of the amount that's been transferred into the trust, would fall outside of her estate for inheritance tax valuation purposes. So what does that mean in terms of numbers? So we've now got the taxable estate has been reduced by £320,000. Also, the income has been increased by over £18,000, which is, a double whammy, really. You've got an IHT reduction, and also the value of the income stream was also being increased. So quite a significant advantage by undertaking all of this. And then overall, what does it mean in terms of IHT saving? Well, even if something happens immediately, you've got an IHT saving there of £128,000 over undertaking absolutely no planning whatsoever. Also, you've got the ability to potentially look at restructuring the UK SIP if double taxation treaties permit that, and that would further reduce the overall inheritance tax liability that could arise on death.
Could you elaborate on that point a little, Neil? How may it be possible to restructure the SIP, and how might that help?
Sure, yeah. So a number of countries around the world have got double taxation treaties with the UK. Under those taxation treaties, the country where the individual is resident may or may not have taxing rights over the value of that pension pot. So where they have got taxing rights over the value of that pension, it means that the UK would be able to pay out the value of that pension pot free of any UK tax. So it'd be paid out gross. Now, it does require the individual to be able to get an NT code, so a no tax code, and for that to be submitted to HMRC. So normally that would require the individual to be able to demonstrate that they are tax resident in that other country. The other country's got taxing rights over the pension through the double taxation treaty that exists. And if that information is provided to HMRC, HMRC will then issue an NT code, a no tax code. That can be provided to the UK pension provider, and the UK pension provider, providing the individual is 55 or more and able to access the pension benefits in the UK, could pay out the value of that pension pot free of any UK tax. That individual will then be able to look at things like the discounted gift trust and look to mitigate their inheritance tax position going forward if they're going to become a long-term UK tax resident in the future.
Okay, great. And just for the benefit of everyone watching, applying for the NT tax code can be a little bit messy, but it's something we can help you out with. So if you are interested in that, feel free to reach out. And just before we move on, just to say to everyone, if you do have any questions, please pop them in the Q&A box here, and then we'll try and go through a few of those if we have time at the end. Okay, over to you again, Neil.
Okay, thanks. So in summary, what does this do? It's a great piece of planning that, normally whenever you think about giving assets away into trust, you are cutting yourself off from a lot of the access to that trust fund once it's been set up. So your beneficiaries can receive something from it, but typically you can't. With a discounted gift trust, it allows you to receive an income for life or until such time as the trust fund is exhausted. It gives you an immediate discount for inheritance tax valuation purposes without having to wait the full value of the 7 years for the assets to fall outside of your estate. So it's a really useful piece of planning that works particularly well.
Just on that, Neil, is there any sort of qualifying criteria, like in terms of the health of the client? If if the life expectancy is less than normal, would that affect this in any way?
It does, yes. So the individual needs to be underwritten because even though we will use some standard mortality tables prescribed by HMRC, we do need to be able to establish that that person has a reasonable chance of being able to reach the life expectancy that's set out in those mortality tables. So a health questionnaire has to be completed. The individual then goes through an underwriting procedure to determine their life expectancy, providing there are no untoward health issues, etc. Then typically standard rates are assumed, and therefore a standard discount is then calculated by our system to determine how much would fall outside of the estate for the individual on day one. If the individual can't be underwritten, then we would not be prepared to issue a discount. The reason for that is that this particular type of planning is bread and butter from a UK tax perspective. It's very popular, and as a result, over the years, HMRC have looked at it quite carefully to make sure it works as they expect it to. And quite a few years ago now, individuals were undertaking this particular type of planning without being underwritten. And HMRC queried those cases and effectively said that, this person's state of health was such at the time whenever they embarked on it that there was no reasonable chance of them receiving, a large proportion or even a small proportion of the income stream that had been carved out for them. So they wouldn't agree to the discount that had been calculated. So the way that we operate now, other providers may be different, but if we can't underwrite the client and advise a discount, then we don't proceed any further with the planning, because it's not good for anybody.
Yeah, that's a really important point, actually. It's kind of similar to the situation where, once you've had a heart attack, it's probably, or once you've been diagnosed with cancer, it's very difficult to go and get life insurance, right? So it just kind of highlights the really important need to make this planning in advance in order to kind of really benefit from it the most. So that's interesting.
Yeah, it is. I mean, like a lot of things, whether or not it's someone that they may not have set up a will, they might not be particularly bothered about it, but it's the estate that comes along that has to pick up the pieces that they're going to struggle in terms of what's gone on. And this is no different in that if we issue a discount, then that discount has been issued in accordance with HMRC rules, practices and expectations. And therefore, even if something does happen to the client individual very early on, the executors would be able to use that discount and be confident that HMRC are going to accept it. Now, if the individual hasn't been underwritten and another company has given them a discount, then it's significantly less likely that that conversation with HMRC in terms of how that scheme has been set up is likely to achieve its objectives.
Okay, perfect.
So it's really straightforward in terms of how these types of structures work. So you have your insurance wrapper that you're applying for at the same time. Your application comes in together with a health questionnaire and a trust that's completed but not dated. Our underwriters would review the medical information they're provided with, and if necessary, request that a light touch medical is undertaken. After that, providing all of that's successful and we can agree a discount, then if death occurs within 7 years, only a small proportion of the amount that's been transferred into the trust will fall into their estate for IHT valuation purposes, with the remainder falling outside. And the very important point, there is an illustration that's produced that the estate can be able to use and utilise if there's ever a query by HMRC in terms of why this particular piece of planning was undertaken. And that's it. That's the end of those slides.
Okay, brilliant. Thanks for that, Neil. If anyone does have a question, feel free to please drop it into the Q&A box that you will see in the Zoom window there. There is a couple of questions, so I'll just throw a few of these at you, Neil, if that's okay. Someone's asking here, is it possible from a UK tax perspective to be resident nowhere, i.e. you don't spend enough time in any particular country to be classed as tax resident? Is that a possibility? Is that a real thing?
It's very difficult now, unless you've got no financial accounts and you're completely, off the radar. You're walking the earth effectively with your worldly possessions on your back. There are a few kind of international information sharing arrangements which have been introduced over the years. One is the common reporting standards, whereby if you've got an account in any jurisdiction, then that information is potentially going to be shared with other jurisdictions around the world where you are most closely connected. So it might be possible, but it's significantly more different now with the way the world works in respect of information sharing arrangements than it may have been in the past.
I guess essentially, as soon as you have a what you would call a home somewhere, that sort of option is kind of off the table. Even if you're sort of spending less than 90 days in that particular place, is that is the concept of the center of vital interest, is that still a concept where they kind of look at where you're sort of deemed, it's sort of a vague idea, but essentially where most people would think you're based? Would that be correct to say?
Yeah, it is. I mean, that concept kind of harks back to what was the domicile provisions. But it's like anything really, I guess. If the numbers are big enough and you're not closely connected to any particular jurisdiction, then someone's potentially going to look to get a slice of the value of your estate from a tax perspective.
I see. Okay. And just another question here. How likely is it that future legislation sort of reverses these benefits? So, for is there a concept of once you're in, you're in, and as long as it was legitimate tax planning at the time, if a future government was to change the law, would you still benefit from the provisions as they currently are today?
Yeah, you can never say never, but there's a lot of I guess cases and previous examples where changes in policy have occurred, and anything that's already remained in place has been fine. But anything going forward, you no longer get those tax benefits. So we saw that last year with whenever the new administration came into the UK. There was a particular piece of planning that was very popular for non-UK domiciles who use something called an excluded property trust. The previous Conservative government had said that they were going to leave those alone whenever they were making changes to how the domicile rules worked in the UK. But Labour initially said that they were going to change them. They rode back on that after thinking it through, and anybody that's already got an excluded property trust will continue to be protected from a UK inheritance tax provision going forward. However, if you set a new one up, you won't. And there are lots of examples like that. The way things usually work is that if there's a change in tax policy, then more often than not, there's a consultation on that tax policy. And then people like myself and various other industry bodies will have the opportunity to be able to feed into that consultation and set out, whether or not there's any real view or any real kind of feeling of significant avoidance in that particular planning area. More often than not, the actual outcome of the consultation is probably different to the questions that were asked originally. But it's a long answer to what was a short question. But typically, unless there's been any real abuse of rules which already existed at that point in time, then if things were done in the right way and in line with the expectations that HMRC had, in particular how that particular piece of legislation was drafted and how people work with it, then you are grandfathered in, and what you've got in place will continue to stand. You might not be able to do it again, but what you'll have will continue to have those tax advantages.
Okay, great. Because that's a question I do get asked a lot. It's like it's all very well setting up these structures, but how can we be sure that all these benefits won't be taken away and then we're kind of wasting our time? Because for the benefit of everyone listening, there used to be one of these big benefits on the offshore bonds many years ago called deemed gain, which, as I remember, I think it was a 15% compounded gain on or tax deduction essentially on the insurance bond, and the government kind of took that away. But I think everyone who did have that bond set up before the date of that repeal of that gain, of that benefit, did continue to enjoy that. I think that was correct, wasn't it?
Yeah, there are lots of examples like that. I mean, that's one particular one. But yeah, typically what tends to happen is that if they look at something and feel that maybe isn't the correct interpretation of tax policy, then they'll make that change. But anybody that's relied on that particular piece of tax policy up until that point in time is usually able to continue to enjoy it.
Okay, that's quite reassuring from a planning perspective. So as long as you're kind of doing the planning properly from the beginning, and I think HMRC have a phrase that they like to wheel out against the spirit of the legislation. So if a sort of a tax dodging strategy was sort of thought up, there's been several famous ones, but there was one that drew in. I remember Sir Alex Ferguson, who used to be the manager of Manchester United, got drawn into a spurious scheme where I believe they set up a film production company and they sort of manufactured these losses to offset some tax and so on. And that was sort of examined by the court or by HMRC and deemed to be against the spirit of the legislation. So as long as you're sort of playing ball and following the rules as they are set out, then the planning is pretty sort of legitimate. I just noticed that one of the participants raised a hand hand on the Zoom button, but by virtue of how this presentation is set up, we can't bring people in to ask questions verbally. But if you would like to click on the Q&A box, which is 2 boxes over from the raise hand, you'll be able to type in a question in there. I don't know exactly who that was raising that hand, but if you'd like to pop a question in there for the next minute or so, please do. And just quickly, before we wrap up, Neil, I just wanted to mention that the general benefits of the insurance wrapper that you mentioned, obviously you talked there in detail about wrapping a trust around it for particularly inheritance tax benefits. But if people are not ready to wrap the trust around and kind of, have that complications that, the additional sort of complexity involved with that, if we just quickly summarize the benefits of the insurance wrapper, whereby people can draw out that 5% tax deferred withdrawal. So say, for example, someone has £1 million in a tax wrapper, they go back to the UK. There's some immediate benefits there, even without the trust. I think that's correct, isn't it? That's still available.
Yeah, these products are typically, certainly for the UK environment anyway, they're tax neutral. So it doesn't matter really, what you're invested in within there. Any gains that are realised with the insurance product don't accrue directly to you, so it's tax neutral, as opposed to, let's say, an investment platform where you constantly have to be looking at, am I realising gains? Am I generating an income? How do I account for that? How do I file for that? My tax return, etc. So the tax neutral, very easy product to run and maintain, which is why they kind of lend themselves quite well to being within a trust structure, because there's very little for the trustees to do once it's been set up, as opposed to running a similar amount of money through a platform or through holding assets directly. There are advantages for people that hold them and take them out as a non-UK long-term resident and become long-term resident in the future, in that you're allowed to offset periods of growth that have deemed to accrue whilst you are non-UK resident. That's something called time apportionment relief. And there are a number of other different benefits too. So I guess the main thing is that the tax neutral, it's really up to the individual as to when they realise a tax liability on that product. And for that reason, they're very, very popular for people that will move to the UK or who are already a UK resident.
Okay, that's great. One of the questions I get asked a lot about these products and these strategies is, people say, "Oh, it makes sense when you explain it to me here and now, but 6 months later, I kind of come back to it and think, oh, how did that credit work? What was that benefit, and how is it accumulated, and how has it worked out? And am I going to be able to calculate all this stuff in 5 or 10 years, or do I need to, go and get an accountant at that time?" But I think it's correct to say that RL360 setting up these structures will essentially be able to step in and help with how much benefit has been accrued at a particular time when it's being accessed. And obviously, as the advisor with Holborn, I would be there with that person. But if we're talking sort of 20 years on, and if I'm no longer here because I've fallen under a bus or whatever, then RL360 are able to essentially kind of help with do those calculations, and the individual who set this up doesn't have to worry about sort of getting out their calculator. Is that correct?
We will work with advisors who are linked to those clients, and we're very happy to support those advisors in whatever way they need to be able to look after their clients correctly.
Okay, perfect. So yeah, thank you for that, Neil. I think we'll probably call it a day there. It's an interesting topic, and it's kind of one that is quite sort of expansive when you get into it, because obviously everyone's individual circumstances are slightly different, and there'll be some nuances, and I'm sure people will have additional questions, and that's perfectly normal and obviously very welcome. So anyone who is listening now, feel free to reach out if you'd like to have an individual chat about this in terms of relating this to your individual circumstances. Obviously, this type of structure and advice is always very personalized, as most advice is. And if you're watching this on YouTube later on, feel free to pop in a comment underneath the video here. I'm very happy to get back to everyone. If you have a comment or a question, more than happy to do that. So with that, I think we will say thanks very much for joining us, everyone. Thanks for your time, Neil. Always appreciate that. Always enjoy having a chat with you. And everyone watching, thank you for attending. And as and when there is any new updates or information in this area, of course, we'll be doing additional presentations and webinars in the future. But until then, thank you for watching.